Thank you for pressing play. Your presence here brings joy to my heart. We're thrilled to present to you our video dedicated to state income tax. Enjoy. Thumb up right atop marginal state income tax withholding rate. In addition to federal income tax collected by the United States, most individual U.S. states collect a state income tax. Some local governments also impose an income tax, often based on state income tax calculations. 42 states and many localities in the United States impose an income tax on individuals. 8 states impose no state income tax, and a ninth, New Hampshire, imposes an individual income tax on dividends and interest income but not other forms of income, though it will be phased out by 2027. 47 states and many localities impose a tax on the income of corporations. State income tax is imposed at a fixed or graduated rate on taxable income of individuals, corporations, and certain estates and trusts. These tax rates vary by state and by entity type. Taxable income conforms closely to federal taxable income in most states with limited modifications. States are prohibited from taxing income from federal bonds or other federal obligations. Most states do not tax Social Security benefits or interest income from obligations of that state. In computing the deduction for depreciation, several states require different useful lives and methods be used by businesses. Many states allow a standard deduction or some form of itemized deductions. States allow a variety of tax credits in computing tax. Each state administers its own tax system. Many states also administer the tax return and collection process for localities within the state that impose income tax. State income tax is allowed as an itemized deduction in computing federal income tax, subject to limitations for individuals. Now, let's shift our attention to basic principles. State tax rules vary widely. The tax rate may be fixed for all income levels and taxpayers of a certain type, or it may be graduated. Tax rates may differ for individuals and corporations. Most states conform to federal rules for determining gross income, timing of recognition of income and deductions, most aspects of business deductions, characterization of business entities as either corporations, partnerships, or disregarded entities. Gross income generally includes all income earned or received from whatever source, with some exceptions. States are prohibited from taxing income from federal bonds or other federal obligations. Most states also exempt income from bonds issued by that state or localities within the state, as well as some portion or all of Social Security benefits. Many states provide tax exemption for certain other types of income, which varies widely by state. States uniformly allow reduction of gross income for cost of goods sold, though the computation of this amount may be subject to some modifications. Most states provide for modification of both business and non-business deductions. All states taxing business income allow deduction for most business expenses. Many require that depreciation deductions be computed in manners different from at least some of those permitted for federal income tax purposes. For example, many states do not allow the additional first-year bonus depreciation deduction. Most states tax capital gain and dividend income in the same manner as other investment income. In this respect, individuals and corporations not resident in the state generally are not required to pay any income tax to that state with respect to such income. Some states have alternative measures of tax. These include analogues to the federal alternative minimum tax in 14 states, as well as measures for corporations not based on income, such as capital stock taxes imposed by many states. Income tax is self-assessed, and individual and corporate taxpayers in all states imposing an income tax must file tax returns in each year their income exceeds certain amounts determined by each state. Returns are also required by partnerships doing business in the state. Many states require that a copy of the federal income tax return be attached to their state income tax returns. The deadline for filing returns varies by state and type of return, but for individuals in many states is the same as the federal deadline, typically April 15. Every state, including those with no income tax, has a state taxing authority with power to examine, audit, and adjust returns filed with it. Most tax authorities have appeals procedures for audits, and all states permit taxpayers to go to court in disputes with the tax authorities. Procedures and deadlines vary widely by state. All states have a statute of limitations prohibiting the state from adjusting taxes beyond a certain period following filing returns. All states have tax collection mechanisms. States with an income tax require employers to withhold state income tax on wages earned within the state. Some states have other withholding mechanisms, particularly with respect to partnerships. Most states require taxpayers to make quarterly estimated tax payments not expected to be satisfied by withholding tax. All states impose penalties for failing to file required tax returns and to pay tax when due. In addition, all states impose interest charges on late payments of tax, and generally also on additional taxes due upon adjustment by the taxing authority. Now, let's shift our attention to individual income tax. Thumb up right Earth average effective state and local taxes for all states for different income groups. Sales taxes and excise taxes blue, property taxes green, state income taxes red, and total taxes clear. 43 states impose a tax on the income of individuals, sometimes referred to as personal income tax. State income tax rates vary widely from state to state. States imposing an income tax on individuals tax all taxable income as defined in the state of residence. Such residents are allowed a credit for taxes paid to other states. Most states tax income of non-residents earned within the state. Such income includes wages for services within the state as well as income from a business with operations in the state. Where income is from multiple sources, formulary apportionment may be required for non-residents. Generally, wages are apportioned based on the ratio days worked in the state to total days worked. All states that impose an individual income tax allow most business deductions. However, many states impose different limits on certain deductions, especially depreciation of business assets. Most states allow non-business deductions in a manner similar to federal rules. Few allow a deduction for state income taxes, though some states allow a deduction for local income taxes. 6 of the states allow a full or partial deduction for federal income tax. In addition, some states allow cities and counties to impose income taxes. For example, most Ohio cities and towns impose an income tax on individuals and corporations. By contrast, in New York, only New York City and Yonkers impose a municipal income tax. Let's zoom in on states with no individual income tax and understand its implications. Thumb up right states with no state individual income tax are in red. States taxing only dividend and interest income are in yellow. 8 U.S. states and the District of Columbia do not levy a broad-based individual income tax. Some of these do tax certain forms of personal income. 1. Alaska no individual tax but has a state corporate income tax. Alaska has no state sales tax, but lets local governments collect their own sales taxes. Alaska has an annual permanent fund dividend, derived from oil revenues, for all citizens living in Alaska after 1 calendar year, except for some convicted of criminal offenses. 2. Florida no individual income tax but has a 5.5% corporate income tax. The state once had a tax on intangible personal property held on the first day of the year: stocks, bonds, mutual funds, money market funds, etc. But it was abolished at the start of 2007. 3. Nevada no individual or corporate income tax. Nevada gets most of its revenue from sales taxes as well as taxes on the gambling and mining industries. 4. New Hampshire no individual income tax. taxes, dividends, and interest on investment income at 4% in 2023, set to decrease by 1% each year until it reaches 0% in 2027. The 2023 budget, likely to be signed by the governor, repeals this tax at the start of 2025. For large businesses, the 0.55% business enterprise tax is essentially an income tax. The state also has a 7.6% business profits tax, scheduled to drop to 7.5% in 2024. 5. South Dakota, no individual income tax but has a state franchise income tax on financial institutions. 6. Tennessee has no individual income tax. In 2014, voters approved an amendment to the state constitution prohibiting state or local governments from levying any income tax. Prior to January 1, 2021, Tennessee had the whole income tax, a tax on certain interest and dividend income from investments. 7. Texas, no individual income tax but imposes a franchise tax on corporations. In May 2007, the legislature modified the franchise tax by enacting a modified gross margin tax on certain businesses. Sole proprietorships and some partnerships were automatically exempt. Corporations with receipts below a certain level were also exempt, as were corporations whose tax liability was also below a specified amount, which was amended in 2009 to increase the exemption level. The Texas Constitution bans the passage of an income tax, with a majority of the legislature required to repeal the ban. 8. Washington, no individual tax but has a business and occupation tax BOE on gross receipts, applied to almost all businesses located or doing business in Washington. It varies from 0.138% to 1.9% depending on the type of industry. In July 2017, the Seattle City Council unanimously approved an income tax on Seattle residents, making the city the only one in the state with an income tax. It was subsequently ruled unconstitutional by the King County Superior Court. The Court of Appeals upheld that ruling, and the Washington Supreme Court declined to hear the case, maintaining the tax as unconstitutional and unenforceable. In 2022, through the Long-Term Care Trust Act, Washington began taxing high net worth individuals once capital gains exceeded $250,000. Stakeholders advocating for adoption of this act include assisted living, adult family home, and nursing home providers, labor unions, area agencies on aging, businesses, the AARP, and more. 9. Wyoming, no individual or corporate income taxes. As we enter this new phase, let's navigate the complexities of states with flat-rate individual income tax and discover its practical applications. 7 states have a flat-rate individual income tax. 1. Colorado 4.4% 2023. 2. Illinois 4.95% July 2017. 3. Indiana 3.23%. Counties may impose an additional income tax. See taxation in Indiana. 4. Michigan 4.25% 2016-22. Cities in Michigan may levy an income tax, with non-residents paying half the rate of residents. 5. North Carolina 4.99% 2022. 6. Pennsylvania 3.07%. Many municipalities in Pennsylvania assess a tax on wages. Most are 1%, but can be as high as 3.75% in Philadelphia. School districts may also impose an earned income tax up to Act 32 limits. 7. Utah 4.85% 2022. Get ready for an exciting part as we dive into states with local income taxes in addition to state-level income tax. Thumb-bright are green states without state-level or local-level individual income taxes. Light green states with state-level individual income tax on interest and dividends only but no local-level individual income taxes. Yellow states with state-level individual income tax but no local-level individual income taxes are in yellow. Light orange states with state-level individual income tax and local-level individual income taxes on payroll only are in dark yellow light orange. Orange states with state-level individual income tax and local-level individual income tax on interest and dividends only. Red states with state-level and local-level individual income taxes. The following states have local income taxes. These are generally imposed at a flat rate and tend to apply to a limited set of income items. Alabama counties, including Macon County, and municipalities, including Birmingham, employees on payroll only. California, San Francisco, payroll only. Colorado, some municipalities, including Denver and Aurora, flat fee occupational privilege tax for privilege of working or conducting business, filed with municipality imposing fee. Delaware, Wilmington earned certain Schedule East income, as well as capital gains from sale of property used in business. Income must be reported to the City of Wilmington if Wilmington tax is not withheld by employer. Indiana, all local taxes reported on state income tax formal counties. Iowa, all local taxes reported on state income tax for many school districts and Apponews County. Kansas, some counties and municipalities interest and dividend income reported on separate state Form 200 filed with the county clerk. Kentucky, most counties, including Kenton County, Kentucky, and municipalities, including Louisville and Lexington, earned income and certain rental income that qualifies as a business, reported as occupational license fee tax by employer or as net profits tax by business, filed with county or municipality imposing tax. Maryland, all local taxes reported on state income tax formal counties, and the independent city of Baltimore. Michigan, many cities, including Detroit, Lansing, and Flint, most income above a certain annual threshold, reported on form issued by imposing city or on separate state form in the case of Detroit. Missouri, all other cities are prohibited from imposing local income tax. Kansas City earned income. Income must be reported to Kansas City if city tax is not withheld by employer. Residents must file the earnings tax form to report wages on which Kansas City income tax is not withheld, and the business earnings tax form to report self-employment income. St. Louis earned income. Income must be reported to the City of St. Louis if St. Louis tax is not withheld by employer. Resident must file the earnings tax form to report wages on which St. Louis income tax is not withheld, and the business earnings tax form to report self-employment income. New Jersey, Newark, payroll only. New York, all local taxes reported on state income tax form. New York City employees with NYC Section 1127 withholding should also file New York City Form 1127. Yonkers Metropolitan Commuter Transportation District, self-employed with income sourced from New York City, as well as the counties of Dutchess, Nassau, Orange, Putnam, Rockland, Suffolk, and Westchester. OESOM school districts, either traditional or earned income tax base, reported on separate state form SD 100. RITA, regional income tax agency. Most cities and villages more than 600 out of IXP on earned income and rental income. Some municipalities require all residents over a certain age to file, while others require residents to file only if municipal income tax is not withheld by employer. Income is reported on a tax form issued by the Municipal Income Tax Collector, currently Cleveland's Central Collection Agency CCA, or the Regional Income Tax Authority RITA, or a collecting municipality. Municipalities such as Columbus and Cincinnati sometimes also collect for neighboring towns and villages. Auburn, Portland, all residents must file an arts tax form with the city to either pay the flat fee tax or qualify for an exemption based on low individual or household income. Lane Transit District, self-employed with income sourced from Lane Transit District, which includes parts of Lane County, reported on separate state tax form. LTD, Tri-County Metropolitan Transportation District, self-employed with income sourced from TriMet, which includes parts of Clackamas, Multnomah, and Washington counties reported on separate state tax form TM. Other transit districts, businesses with income sourced from those transit districts filed with transit districts or municipalities administering transit districts. Pennsylvania, most municipalities, including Pittsburgh and Allentown, and school districts and income-only local return must be filed by all residents of municipality or school district imposing local earned income tax with the local earned income tax collector, such as Berkheimer, Keystone Collections, or Jordan Tax Service. An additional local services tax, potentially refundable if income is below a certain threshold, is also imposed by some municipalities and school districts on earned income sourced from those municipalities and school districts. Local earned income tax collectors' rates and local service tax refund rules can be found on the Pennsylvania Municipal Statistics website. Philadelphia. Earned and passive income. Income must be reported to the City of Philadelphia if Philadelphia tax is not withheld by employer. Residents must file the earnings tax form to report wages on which Philadelphia income tax is not withheld, the net profits tax form to report self-employment, business, and most rental income, and the school income tax to report passive income excluding interest earned from checking and savings accounts. An additional business income and receipts tax is also imposed on business income sourced from Philadelphia. Individuals earning less than amount that would qualify them for the Pennsylvania Income Tax Forgiveness Program are eligible to receive a partial refund of their wage tax withheld by filing a refund application. West Virginia. Some municipalities, including Charleston and Huntington Flats, city service fee for privilege of working or conducting business, filed with municipality imposing fee. Now, let's shift our perspective and explore corporate income tax from a different angle. Fund upright estate corporate taxes 2022. Most states impose a tax on income of corporations having sufficient connection nexus with the state. Such taxes apply to U.S. and foreign corporations, and are not subject to tax treaties. Such tax is generally based on business income of the corporation apportioned to the state plus non-business income only of resident corporations. Most state corporate income taxes are imposed at a flat rate and have a minimum amount of tax. Business taxable income in most states is defined, at least in part, by reference to federal taxable income. According to Tax Foundation, these states have no state corporate income tax as of February 1, 2020. Nevada, Ohio, South Dakota, Texas, Washington, and Wyoming. However, Nevada, Ohio, and Washington impose a gross receipts tax while Texas has a franchise tax based on taxable margin, generally defined as sales less either cost of goods sold less compensation, with complete exemption, no tax owed for less than in annual earnings, and gradually increasing to a maximum tax of 1% based on net revenue, where net revenue can be calculated in the most advantageous of 4 different ways. Our focus now turns to nexus, an important aspect of our discussion. States are not permitted to tax income of a corporation unless 4 tests are met under Complete Auto Transit, Inc. v. Brady. There must be a substantial nexus connection between the taxpayer's activities and the state. The tax must not discriminate against interstate commerce. The tax must be fairly apportioned, and there must be a fair relationship to services provided. Substantial nexus, referred to generally as simply nexus, is a general U.S. constitutional requirement that is subject to interpretation, generally by the state's comptroller or tax office, and often in administrative letter rulings. In Quill Corporation v. North Dakota, the Supreme Court of the United States confirmed the holding of National Bellers Hess v. Illinois that a corporation or other tax entity must maintain a physical presence in the state, such as physical property, employees, officers, for the state to be able to require it to collect sales or use tax. The Supreme Court's physical presence requirement in Quill is likely limited to sales and use tax nexus, but the court specifically stated that it was silent with respect to all other types of taxes, although we have not in our review of other types of taxes, articulated the same physical presence requirement that Bellas Hesse established for sales and use taxes, that silence does not imply repudiation of the Bellas Hesse rule. Whether qual applies to corporate income and similar taxes is a point of contention between states and taxpayers. The substantial nexus requirement of complete auto supra has been applied to corporate income tax by numerous state supreme courts. Now, let's shift our focus to apportionment and embark on an intellectual exploration of its various dimensions. The courts have held that the requirement for fair apportionment may be met by apportioning between jurisdictions all business income of a corporation based on a formula using the particular corporation's details. Many states use a three-factor formula, averaging the ratios of property, payroll, and sales within the state to that overall. Some states weight the formula. Some states use a single-factor formula based on sales. Get ready to immerse yourself in the world of state capital gains taxes as we examine its impact and relevance. Most states tax capital gains as ordinary income. Most states that do not tax income, Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming, do not tax capital gains either. However, two states, New Hampshire and Washington State, do tax income from dividends and interest. As we venture forward, let's take a closer look at history and its impact on our understanding. The first state income tax, as the term is understood today in the United States, was passed by the state of Wisconsin in 1911 and came into effect in 1912. However, the idea of taxing income has a long history. Some of the English colonies in North America taxed property, mostly farmland, at that time according to its assessed produce, rather than, as now, according to assessed resale value. Some of these colonies also taxed faculties of making income in ways other than farming, assessed by the same people who assessed property. These taxes taken together can be considered a sort of income tax. The records of no colony covered by Rabush for the colonies that became part of the United States separated the property and faculty components, and most records indicate amounts levied rather than collected. So much is unknown about the effectiveness of these taxes, up to and including whether the faculty part was actually collected at Plymouth Colony from 1643 and Massachusetts Bay Colony from 1646. And after they merged, the province of Massachusetts Bay until the Revolution, New Haven Colony from 1649 and Connecticut Colony from 1650, past the 1662 merger with New Haven, until the Revolution, the colony of Rhode Island and Providence Plantations, arguably from 1673 to 1744 or later, the province of West Jersey, a single 1684 law, the southwest part of the province of Carolina, later the province of South Carolina, from 1701 until the Revolution, the province of New Hampshire, arguably from 1719 to 1772 or later, and the Delaware Colony in the province of Pennsylvania, from 1752 to the Revolution. Babushka makes it clear that Massachusetts and Connecticut actually levied these taxes regularly, while for the other colonies such levies happened much less often. South Carolina levied no direct taxes from 1704 through 1713, for example. Becker, however, sees faculty taxes as routine parts of several colonies' finances, including Pennsylvania. During and after the American Revolution, although property taxes were evolving toward the modern resale value model, several states continued to collect faculty taxes. Massachusetts until 1916, when it was replaced by a quasi-modern, classified individual income tax. Connecticut until 1819, South Carolina, where the tax edged closer to a modern income tax, until 1868. Delaware until 1796, Maryland from 1777 to 1780, Virginia from 1777 to 1782, New York, 1778 levy, the Vermont Republic, in Vermont as a state, from 1778 to 1850, and Pennsylvania from 1782 to 1840 when it was replaced by an individual income tax. Becker, as noted above, would date this tax earlier. Between the enactment of the Constitution and 1840, no new general taxes on income appeared. In 1796, Delaware abolished its faculty tax, and in 1819 Connecticut followed suit. On the other hand, in 1835, Pennsylvania instituted a tax on bank dividends paid by withholding, which by about 1900 produced half its total revenue. Several states, mostly in the South, instituted taxes related to income in the ERS. Some of these claimed to tax total income, while others explicitly taxed only specific categories, these latter sometimes called classified income taxes. These taxes may have been spurred by the ideals of Jacksonian democracy, or by fiscal difficulties resulting from the Panic of 1837. None of these taxes produced much revenue, partly because they were collected by local elected officials. Pennsylvania from 1840 to 1871, Maryland from 1841 to 1850, Alabama from 1843 to 1884, Virginia from 1843 to 1926 when it was replaced by a modern individual income tax, Florida from 1845 to 1855, and North Carolina from 1849 to 1921 when it was replaced by a modern individual income tax. The ERS brought another few income tax abolitions, Maryland and Vermont in 1850, and Florida in 1855. During the American Civil War and Reconstruction era, when both the United States of America 1861-1871 and the Confederate States of America 1863-1865 instituted income taxes, so did several state taxes from 1863 to 1871. Missouri from 1861 to 1865, Georgia from 1863 to 1866, West Virginia in 1863 only, Louisiana from 1865 to 1899, and Kentucky from 1867 to 1872. As with the national taxes, these were made in various ways to produce substantial revenue for the first time in the history of American income taxation. On the other hand, as soon as the war ended, a wave of abolitions began. Missouri in 1865, Georgia in 1866, South Carolina in 1868, Pennsylvania and Texas in 1871, and Kentucky in 1872. The rest of the century balanced new taxes with abolitions. Delaware levied a tax on several classes of income in 1869. Then abolished it in 1871. Tennessee instituted a tax on dividends and bond interest in 1883, but Kinsman reports that by 1903 it had produced zero actual revenue. Alabama abolished its income tax in 1884. South Carolina instituted a new one in 1897, eventually abolished in 1918. And Louisiana abolished its income tax in 1899. Following the 1895 Supreme Court decision in Pollock v. Farmers Loan and Trust Company, which effectively ended the federal income tax, some more states instituted their own along the lines established in the 19th century: Oklahoma 1908 to 1915, Mississippi 1912 to 1924, Missouri, individual and corporate, from 1917. However, other states, some perhaps spurred by populism, some certainly by progressivism, instituted taxes incorporating various measures long used in Europe, but considerably less common in America, such as withholding, corporate income taxation as against earlier taxes on corporate capital, and especially the defining feature of a modern income tax, central administration by bureaucrats rather than local elected officials. The twin revenue-raising successes of Wisconsin's 1911, the Wisconsin income tax, the first modern state income tax, was passed in 1911 and came into effect in 1912, and the United States 1914 income taxes prompted imitation. Note that writers on the subject sometimes distinguish between corporate, net income taxes, which are straightforward corporate income taxes, and corporate franchise taxes, which are taxes levied on corporations for doing business in a state, sometimes based on net income. Many states' constitutions were interpreted as barring direct income taxation, and franchise taxes were seen as legal ways to evade these bars. The term franchise tax has nothing to do with the voting franchise, and franchise taxes only apply to individuals insofar as they do business. Note that some states actually levy both corporate net income taxes and corporate franchise taxes based on net income. For the following list, see Add of Territory of Hawaii, then Hawaii as a state, individual and corporate from 1901. This is sometimes claimed as the oldest state income tax. It is certainly the oldest state corporate income tax. Wisconsin, individual and corporate from 1911, generally considered the first modern state income tax, built on a law largely written by Delos Kinsman, whose 1903 book on the subject is cited above. Its major distinction as against older laws, including Hawaii's, is that state bureaucrats rather than local assessors collected it. Connecticut franchise from 1915. Oklahoma, modernization of existing individual tax from 1915. Massachusetts, individual from 1916. Virginia, corporate from 1916. Delaware, individual from 1917. Montana, franchise from 1917. New York, franchise from 1917. Note abolition of South Carolina's non-modern individual income tax in 1918. Alabama, individual, 1919, declared unconstitutional 1920. New Mexico, individual and corporate, 1919, apparently abolished soon thereafter. New York, individual, from 1919. North Dakota, individual and corporate, from 1919. Massachusetts, corporate franchise, from 1919 or 1920. Mississippi's income tax was held to apply to corporations in 1921. North Carolina, modernization of existing individual and institution of corporate taxes, from 1921. South Carolina, individual and corporate, from 1921 or 1922. New Hampshire, intangibles restricted to interest and dividends, from 1923. Oregon, individual and corporate, 1923, repealed 1924. Tennessee, corporate, from 1923. Mississippi, modernization of existing corporate and individual taxes, from 1924. Virginia, modernization of existing corporate and individual taxes, from 1926. This period coincided with the United States' acquisition of colonies, or dependencies, the Philippines, Puerto Rico, and Guam from Spain in the Spanish-American War. American Samoa by agreements with local leaders, 1899-1904, the Panama Canal Zone by agreement from Panama in 1904, and the U.S. Virgin Islands purchased from Denmark in 1917. Arguably, Alaska, purchased from Russia in 1867, and Hawaii, annexed in 1900, were also dependencies, but both were by 1903 incorporated in the U.S., which these others never have been. The Panama Canal Zone was essentially a company town, but the others all began levying income taxes under American rule. Puerto Rico already had an income tax much like a faculty tax, which remained in effect for a short time after Philippines and Puerto Rico from 1913, by the same law that instituted the federal income tax. This law is ancestral to the modern independent Philippines income tax as well, and the U.S. Virgin Islands, from 1922. A third of the current state individual income taxes, and still more of the current state corporate income taxes, were instituted during the decade after the Great Depression started. Arkansas, individual and corporate, from 1929. California, franchise, from 1929. Georgia, individual and corporate, from 1929. Oregon, individual, franchise, and intangibles, from 1929. but the individual tax didn't take effect until 1930 and was restricted to use for property tax relief, and the intangibles tax was held unconstitutional in 1930. Tennessee, intangibles, from 1929. Idaho, individual and corporate, from 1931. Ohio, intangibles, from 1931, apparently abolished soon thereafter. Oklahoma, corporate, from 1931. Oregon, intangibles, 1931 to 1939. Utah, individual and franchise, from 1931. Vermont, individual and corporate, from 1931. Illinois, individual and corporate, 1932, soon declared unconstitutional. Washington, individual and corporate, 1932, declared unconstitutional. 1933. Alabama, individual and corporate, from 1933. Arizona, individual and corporate, from 1933. Kansas, individual and corporate, from 1933. Minnesota, individual, corporate, and franchise, from 1933. Montana, individual and corporate, from 1933. New Mexico, individual and corporate, from 1933. Iowa, individual and franchise, from 1934. Louisiana, individual and corporate, from 1934. California, individual and corporate, from 1935. Pennsylvania, franchise, from 1935. South Dakota, individual and corporate, 1935 to 1943. The U.S. Virgin Islands income tax in 1935 became the first mirror tax, for which see below. Washington, individual and corporate, 1935, held unconstitutional in separate decisions the same year. West Virginia, individual, 1935 to 1942. Kentucky, individual and corporate, from 1936. Colorado, individual and corporate, from 1937. Maryland, individual and corporate, from 1937. District of Columbia, individual and either corporate or franchise, from 1939. A mirror tax is a tax in a U.S. dependency in which the dependency adopts wholesale the U.S. federal income tax code, revising it by substituting the dependency's name for United States everywhere, and vice versa. The effect is that residents pay the equivalent of the federal income tax to the dependency, rather than to the U.S. government. Although mirroring formally came to an end with the Tax Reform Act of 1986, it remains the law as seen by the U.S. for Guam and the Northern Mariana Islands because conditions to its termination have not yet been met. In any event, the other mirror tax dependencies, the U.S. Virgin Islands and American Samoa, are free to continue mirroring if, and as much as, they wish. The U.S. acquired one more dependency from Japan in World War II, the Trust Territory of the Pacific Islands. Two states, South Dakota and West Virginia, abolished Depression-era income taxes in 1942 and 1943, but these were nearly the last abolitions. For about 20 years after World War II, new state income taxes appeared at a somewhat slower pace, and most were corporate net income or corporate franchise taxes. Rhode Island, corporate, from 1947. The Territory of Alaska, then Alaska as a state, individual and corporate, from 1949. Guam, mirror, from 1950. Pennsylvania, corporate, from 1951. Oregon removed the restriction of individual income tax funds to property tax relief in 1953. Delaware, corporate, from 1958. New Jersey, corporate, from 1958. Idaho, franchise, from 1959. Utah, corporate, from 1959. West Virginia, individual, from 1961. American Samoa, mirror, from 1963. Indiana, individual and corporate, from 1963. Wisconsin, franchise, from 1965. As early as 1957, General Motors protested a proposed corporate income tax in Michigan with threats of moving manufacturing out of the state. However, Michigan led off the most recent group of new income taxes. Michigan, individual and corporate, this replacing a value-added tax from 1967, Nebraska, individual and corporate, from 1967, Maryland, individual added county withholding tax and non-resident tax. Believes led to state being mainly a commuter state for work 1967, present West Virginia, corporate, from 1967, Connecticut, intangibles but taxing capital gains and not interest, from 1969, Illinois, individual and corporate, from 1969, Maine, individual and corporate, from 1969, New Hampshire, corporate, from 1970, Florida, franchise, from 1971, Ohio, individual and corporate, from 1971, Pennsylvania, individual, from 1971, Rhode Island, individual, from 1971, the Trust Territory of the Pacific Islands, individual and corporate, from 1971. In the early years, Pennsylvania and Ohio competed for businesses, with Ohio wooing industries with a reduced corporate income tax, but Pennsylvania warning that Ohio had higher municipal taxes that included taxes on inventories, machinery and equipment. A few more events of the years follows. Michigan abolished its corporate income tax in 1975, replacing it with another value-added tax. New Jersey instituted an individual income tax in 1976. The Northern Mariana Islands negotiated with the U.S. in 1975 a merit tax which was to go into effect in 1979, but in 1979 enacted a law abating that tax partially or entirely each year and levying a simpler income tax. Alaska abolished its individual income tax retroactive to 1979 in 1980. Also during this time, the U.S. began returning the Panama Canal Zone to Panama in 1979, and self-government, eventually to lead to independence, began between 1979 and 1981 in all parts of the Trust Territory of the Pacific Islands except for the Northern Mariana Islands. The resulting countries, the Marshall Islands, the Federated States of Micronesia, and Palau, all levy income taxes today. The only subsequent individual income tax instituted to date is Connecticut's, from 1991, replacing the earlier intangibles tax. The median family income in many of the state's suburbs was nearly twice that of families living in urban areas. Governor Lowell Weiker's administration imposed a personal income tax to address the inequities of the sales tax system, and implemented a program to modify state funding formulas so that urban communities received a larger share. Numerous states with income taxes have considered measures to abolish those taxes since the late recession began, and several states without income taxes have considered measures to institute them, but only one such proposal has been enacted. Michigan replaced its more recent value-added tax with the new corporate income tax in 2009. Let's now shift gears and explore rates by jurisdiction through a critical lens, uncovering its strengths and weaknesses. Thumb up right, total state government tax revenue by type in 2020. Without wasting any more time, let's jump into the fascinating world of Alabama. Individual income tax percentage 2%, 4%, 5%. The corporate income tax rate is 6.5%. As we enter this new chapter, let's navigate the complexities of Alaska and unravel its multifaceted nature. Alaska does not have an individual income tax. Corporate income tax income level $0, $24,999, $25,000, $48,999, $49,000, $73,999, $74,000, $98,000, $999, $123,000, $999, $124,000, $147,000, $999, $148,000, $172,999, $173,000, $197,999, $198,000, $221,999. Get ready to immerse yourself in the world of personal income tax as we examine its impact and relevance. Single or married and filing separately, income level $0, $27,271, $27,272, $54,543, $54,544, $163,631. Married filing jointly or head of household, income level $0, $54,543, $54,544, $109,087, $109,088, $327,262. Reference. Without wasting any more time, let's jump into the fascinating world of corporate income tax. The corporate income tax rate is 4.9%. As we enter this new phase, let's analyze Arkansas from different angles and evaluate its significance. Personal income tax, income level $0, $4,000, $400, $4,000, $401, $8,000, $800. Corporate income tax, income level $0, $2,000, $999, $3,000, $5,000, $999, $6,000, $10,000, $999, $11,000, $24,999. As we transition, let's shed light on scheduled rate reductions and its relevance to our ongoing exploration. During a special session of the Arkansas legislature in August 2022, the top personal income tax rate was reduced to 4.9% retroactively effective to January 1, 2022, instead of 2025 as was originally planned, while also marking the first time since 1971 that the top income tax rate has been 5% or lower. During the 2023 session, the top rate was cut from 4.9% to 4.7% retroactive to January 1, 2023. With the foundation laid, let's embark on a journey into California. California taxes all capital gains as income. Let's now enter the realm of personal income tax and discover the fascinating stories it has to tell. Single or married filings separately, 2021 income level $0, $8,931, $8,932, $21,174, $21,175, $33,000, $420, $33,000, $421, $46,000, $393, $46,000, $394, $58,000, $633, $58,000, $634, $299,000, $507, $299,000, $508, $359,000, $406, $359,000, $407, $599,000, and $11, $599,000, and $12, $999,999. Married filing jointly, 2021 income level $0, $17,863, $17,864, $42,000, $349, $42,000, $350, $66,000, $841, $66,000, $842, $92,000, $787, 92,788, $117,267, $117,268, $599,015, $599,016, $718,000. $813, $718,000, $814, $999,000, $999, $1 million, $1,198,023. Head of household not 2021 income level $0, $17,099, $17,099, $40,000. $512, $40,000, $512, $52,000, $224, $52,000, $224, $64,000, $632, $64,000, $632, $76,000, $343, $76,000, $343, $389,000, $627, $389,000, $627, $467,000, $553, $467,000, $553, $779,000, $253. California's listed tax brackets from 1% 12.3% are indexed for inflation and were most recently by 2012 California Proposition 30. Their state has a 1% mental health services surtax form 540, line 62 for incomes above $1 million that creates the maximum bracket of 13.3%. California also separately imposes a state alternative minimum tax form 540, line 52 at a 7% rate, so a taxpayer may end up paying both the AMT and the 1% surtax. Reference. In this segment, we'll be unraveling the complexities of corporate income tax and exploring its multifaceted nature. The standard corporate rate is 8.84%, except for banks and other financial institutions, whose rate is 10.84%. As we transition, let's shed light on Colorado and its relevance to our ongoing exploration. Colorado has a flat rate of 4.55% for both individuals and corporations. As we progress through this video, let's now turn our gaze towards personal income tax. Single or married filing separately 2021 income level $0, $9,999, $10,000, $49,000, $999, $50,000, $99,000, $999, $100,000, $199,000, $999, $200,000, $249,000, $999, $250,000, $499,000, $999. Head of household not 2021 income level $0, $16,000, $16,000 and $1, $80,000, $80,000 and $1, $160,000, $160,000 and $1, $320,000, $320,000 and $1, $400,000. Married filing jointly 2021 income level $0, $19,999, $20,000, $99,000, $999, $100,000, $199,000, $999, $200,000, $399,000, $999, $400,000, $499,000, $999, $500,000, $999,000, $999. Brace yourselves for the next chapter, where we'll be dissecting corporate income tax. Connecticut's corporate income tax rate is 7.5%. Without further ado, let's move on to the topic of personal income tax. Single or married filing separately. 2021 income level $0, $1,999, $2,000, $4,999, $5,000, $9,999, $10,000, $19,999, $20,000, $24,999, $25,000, $59,999. Reference. Now, let's shift our perspective and explore corporate income tax through a fresh lens, unlocking new perspectives. Delaware's corporate income tax rate is 8.7%. Let's now turn our gaze towards state individual income tax rates and brackets and explore the fascinating connections it has to offer. State individual income tax rates and brackets 2021. As we enter this new phase, let's navigate the complexities of state corporate tax rates and brackets and discover its practical applications. State brackets: Alabama 6.5%, $0, Alaska 0%, $0, 2%, $25,000, 3%, $49,000, 4%, $74,000, 5%, $99,000, 6%, $124,000, 7%, $148,000, 8%, $173,000, 9%, $198,000, 9.4%, $222,000, Arizona 4.9%, $0, Arkansas 1%, $0, 2%, $3,000, 3%, $6,000, 5%, $11,000, 5.3%, $25,000, California 8.84%, $0, Colorado 4.55%, $0, Connecticut 7.5%, $0, Delaware 8.7%, $0, Florida 4.458%, $0, Georgia 5.75%, $0, Hawaii 4.4%, $0, 5.4%, $25,000, 6.4%, $100,000, Idaho 6.925%, $0, Illinois 9.5%, $0, Indiana 5.25%, $0, Iowa 5.5%, $0, 9%, $100,000, 9.8%, $250,000, Kansas 4%, $0, 7%, $50,000, Kentucky 5%, $0, Louisiana 4%, $0, 5%, $25,000, 6%, $50,000, 7%, $100,000, 8%, $200,000, Maine 3.5%, $0, 7.93%, $350,000, 8.33%, $1,050,000, 8.93%, $3,500,000, Maryland 8.25%, $0, Massachusetts 8%, $0, Michigan 6%, $0, Minnesota 9.8%, $0, Mississippi 3%, $4,000, 4%, $5,000, 5%, $10,000, Missouri 4%, $0, Montana 6.75%, $0, Nebraska 5.58%, $0, 7.81%, $100,000, Nevada gross receipts tax, New Hampshire 7.7%, $0, New Jersey 6.5%, $0, 7.5%, $50,000, 9%, $100,000, 11.5%, $1 million, New Mexico 4.8%, $0, 5.9%, $500,000, New York 6.5%, $0, North Carolina 2.5%, $0, North Dakota 1.41%, $0, 3.55%, $25,000, 4.31%, $50,000, Ohio gross receipts tax, Oklahoma 6%, $0, Oregon 6.6%, $0, 7.6%, $1 million, Pennsylvania 9.99%, $0, Rhode Island 7%, $0, South Carolina 5%, $0, South Dakota none, Tennessee 6.5%, $0, Texas gross receipts tax, Utah 4.95%, $0, Vermont 6%, $0, 7%, $10,000, 8.5%, $25,000, Virginia 6%, $0, Washington gross receipts tax, West Virginia 6.5%, $0, Wisconsin 7.9%, $0, Wyoming none, Washington District of Columbia 8.25%, $0. State corporate tax rates 2021. In the following section, we'll be immersing ourselves in the captivating world of Australia. State governments have not imposed income taxes since World War II. Between 1915 and 1942, income taxes were levied by both state governments and the federal government. In 1942, to help fund World War II, the federal government took over the raising of all income tax, to the exclusion of the states. The loss of the state's ability to raise revenue by income taxation was offset by federal government grants to the states and, later, the devolution of the power to levy payroll taxes to the states in 1971. Your feedback helps me improve, so please take a moment to leave a comment or review.